25, or could it be 50 basis points? Markets weigh up the Fed. A first rate cut in 4 years appears all but a done deal at next week's FOMC. But a softer set of numbers in recent economic reports has investors upping their bets on a bigger half-point cut. Among those numbers, core inflation is still sticky, but today's US import prices show their largest drop in 8 months. And the last jobs report was weaker than expected, though still relatively robust. Well, Jeff Schulze, head of economic and market strategy at ClearBridge Investments, joins us now. Jeff, first questions first. Will we get a quarter or a half-point cut next week?
Well, after a string of releases from key journalists and comments from Bill Dudley making the case for a 50 basis point rate cut, right now, looking at Fed fund futures, it's a jump ball. 50-50 shot on whether or not we do get a quarter or a 50 basis point rate cut. From a risk management standpoint, it would make sense to front load rate cuts as risks to the full employment side of the Fed's dual mandate now outweigh the risks to a reacceleration of inflation. And this ultimately could be the Fed soft messaging that a 50 basis point rate cut is coming, as generally speaking, there's not a lot of uncertainty as you move to an FOMC meeting, as the Fed doesn't like to surprise the market. So if I had to choose one or the other, I would say given the momentum that we're seeing in pricing, a 50 basis point rate cut is, in my opinion, the likely outcome, but I could easily see them going with a 25.
And what about further down the road? Traders still price in over 100 basis points of Fed cuts by year end, which is something of a disconnect with the Fed's own dot plot projections. What's your view on that?
Well, I think if we get a 25 basis point rate cut next week, we're going to hit 75 basis points by the end of the year. So I think we're going to see consecutive rate cuts from the Fed. If it did start off with a 50, maybe we do hit the 4 rate cuts that are currently priced. But where I do see a disconnect is if we look further out in the curve. Right now, traders are pricing in 9 cuts by June. And if we do have a soft landing in the U.S., which is our base case, I think that is overly optimistic on how many cuts will be forthcoming by the Federal Reserve. I could easily see a situation where we get 5 or maybe 6 rate cuts, which should push up the 10-year Treasury, strengthen the dollar, and maybe disappoint what's being priced in the markets right now.
So even if we do get a soft landing in the US, has the Fed been too slow to react to some weakening in the economy?
I don't think so. I know that a lot of talk about the SOM roll has been triggered, which is a rise of the unemployment rate of 0.5% over the trough of the last year on a 3-month average basis. And generally speaking, when you've seen the SOM roll triggered, you've always had a recession. But most of the increase of the unemployment rate has been from people entering into the labor market. Very different implications than people being let go of their jobs, where you lose your income and then you stop your consumption, and that ultimately slows economic activity. So while the labor market is slowing, I think this is more normalization following elevated post-pandemic growth rather than something more sinister like a recession.
One item in last week's jobs report was that average hourly earnings were still up 3.8% year on year. Do you think that's the possible deal breaker when it comes to the policymaker decision next week?
I don't. Yes, it was a warm print, but the path for wage inflation has been down over the last couple of years. And I think more importantly, when you look at the quits rate that you get from the job openings release, and you also look at other leading measures of wage growth, all signal that wage growth should continue to moderate as we look out on the horizon. And even with the CPI release that we got earlier this week, Supercore, which is services ex shelter, which has a very strong relationship and correlation with wage growth, did pick up, but doesn't suggest that wage growth is going to move higher from here. But ultimately, you've seen inflation move lower, and our belief is that you're going to continue to see more disinflation as we turn the page to 2025.
So amid all those variables that you've just outlined there, Treasury yields have been coming down. Where do you see Treasury markets going from here, especially as bets appear to be swinging towards a Kamala Harris win in November?
Well, if you look at Treasury yields, they generally drop when you have a rate cutting cycle that coincides with a soft landing. So we've had 2 rate cutting cycles where this has happened, which is 1995 and 1984. And in the 3 months prior to that rate cutting cycle starting, the 10-year Treasury has dropped 1.2% on average. And you've seen a pretty material drop of the 10-year Treasury thus far. But Once that first rate cut comes, the 10-year Treasury usually bounces, and I would expect a similar situation this time around, especially if the Fed does disappoint on what's being priced for rate cuts as we move to the middle part of next year. So I don't think the 10-year Treasury is going to move up dramatically from these levels, but I could see it moving back up to the 4% range and staying there next year.
And Jeff, the same question for stocks. What's your outlook there? We're seeing a big weekly bounce this week, and the S&P 500 is back to near record highs. Where do you put your money in this environment, and where do you see potential upside?
Well, it wouldn't be surprised to us if we do see continued volatility as we make our way to the election. Volatility does ramp up as you move towards election day, but the key takeaway is once you get through the election and there's more certainty on the political front, the markets rally whether the incumbent party retains control of the White House or the opposition party takes control. So I'm expecting some choppiness over the next couple of months, but ultimately, if a soft landing does materialize and we see a reacceleration of economic momentum next year, we think the equity markets are going to continue to move higher. And from an opportunity standpoint, I believe that there's an opportunity in a lot of the areas in the market that have lagged. Since the soft report that was released for June CPI on July 11th, you've seen a rotation out of the Magnificent Seven into the S&P 493, so the rest of the index, with a Magnificent Seven underperforming by around 15%. And I think part of this is that you've had some concentration risk in those biggest names that have been outperformers over the last couple of years, but you're seeing much better earnings delivery for the rest of the index. And that earnings gap is going to continue to close as we look out on a 6 or 12-month basis. So I think this rotation into the other areas of the market that have been in an earnings recession is going to continue.
Okay, we'll leave it there. Jeff Schulze, Head of Economic and Market Strategy at ClearBridge Investments. Many thanks for sharing your thoughts with us today. That is Market Insight. You can watch more videos on Reuters.com.